get you an update on the markets now. The Johannesburg Stock Exchange poised for another bumpy ride this morning as the military conflict between Russia and Ukraine continues unabated. The local markets have been protected against steep global market sell-offs. This is thanks to higher commodity prices. Matete Thulare is the head of foreign exchange execution at the Rand Merchant Bank. He joins us now for an update on how the JSE is performing this morning. Mr. Thulare, thank you very much for your time. Let's start with the Rand, which is slightly lower in early trade, but was slightly strong compared with the levels that it touched on Wednesday. Talk us through how the currency is faring this hour.
Good morning, Dolly. I suppose, you know what, the country's rand debt is obviously facing quite a lot of pressure as the surging oil prices have really upended the inflation expectations in a lot of net importing nations. Now, the market sentiment has actually ramped up forecasts for interest rate hikes from the Reserve Bank locally. We do know that Lesotho and team are meeting on the 24th of March, where they will be deciding on that interest rates decision. But Russia's invasion of Ukraine, I mean, that's been the biggest story that has been in the markets and obviously on the news feed for the past week and a half. And I suppose the biggest attack on a European state since World War II. Now, this has thrown financial markets into turmoil. I mean, I'm now coining this COVID 2.0 because we're moving away from a pandemic into a geopolitical tension and situation whereby obviously, you know, now it's more politics more than anything. And it's really turned it into turmoil after several countries have obviously imposed sanctions and even global brands have exited Russia in droves. Now, the Rand continues to trade in a really wide range where we've seen ourselves touch that 15.56 level, as you say, against the dollar on Wednesday afternoon. So for a currency such as the Rand and an emerging market currency, the short-term drivers is going to be all about risk appetite, which remains really flaky and uncertain. And, you know, despite the fundamentals suggesting huge scope for Rand gains, eventually risk for the interim will be really based on what happens in terms of the unfolding situation in Eastern Europe.
Yeah, let's talk commodity prices. Oil prices are up and so is gold, while supply concerns, though, are pushing palladium to the highest prices since last July. Talk us through those commodity moves.
So as you know, Toli, I suppose even just a week and a half ago where Enoch Godongwana, stipulated in his maiden budget speech that obviously the super cycle that we are seeing in commodities, that has actually benefited the country. And we've actually seen a broad-based rally across palladium, gold, platinum, and coal. Now, the prices of platinum and palladium are up 3% and 7.5% respectively week to date. But I think what's really on our radar and, giving us a big headache is obviously oil. Now, oil has headed for its biggest weekly surge in almost 2 years. This is obviously on the back of the invasion of Ukraine. As I said earlier, it's shook global market and it's obviously fueling, the supply crunch as you speak about. I mean, this has now made oil prices their highest since 2008. Now, that's close to a 13-year high. So, Ukrainian officials this morning said that Russian forces have obviously attacked the nuclear plant, which has obviously led to another spike in oil and other commodities. But if you just look at crude oil this week, it's up 20%. And what's obviously also really quite interesting, the likes of BP, Shell, Exxon Mobil, they're all exiting Russia. And the buyers of crude are seeking alternatives and shipping costs are also increasing. Now, this obviously throws a real big threat to the global oil security, and obviously the supply squeeze is very much real. We've heard about Iran nuclear deal. That won't actually replace any loss to Russian production on the international market. I think the only thing it will do, it will just give a temporary reprieve to the oil prices. And already, I mean, we're starting to talk and, the market sentiment is that we could potentially touch $185 a barrel for oil if the Russian supply continues to be disrupted. And, from a local perspective and for the local consumer, just yesterday when we were looking at the under recovery on the fuel price, that is around R1.90 for the fuel price in March. So consumers can certainly brace themselves for a further increase in petrol prices in the next few weeks.
Let's continue the conversation around Russia. Ratings agency S&P Global dragging that country's rating into junk status territory even deeper. What does that mean for Russia's ability to borrow and trade?
I suppose, Tolly, if you think about it, just a year or two ago, we were the ones that were really worried about ratings agencies. Now it's on the other side of the world. And, ratings agencies, S&P yesterday came out to cut Russia's credit rating, which obviously throws them into deeper junk territory. Obviously, this has been fueled by the international sanctions triggered by the invasion of Ukraine. S&P downgraded their solid rating to CCC minus. Now, that's from BB plus. And this is less than a week after dropping it from investment grade. So obviously, you can imagine that as a lot of countries need to go into the borrowing market, they do look at your credit rating. So that does affect Russia. Now, the new restrictions from the G7 countries and capital controls introduced by the Russian government to protect their currency, could constrain the nation's ability to pay its debt. What also S&P highlighted is that further downgrades will be kept, on watch, and possibly it could happen that if the situation unfolds and, it deteriorates, there could be further downgrades happening in the next few weeks. But already we also saw the likes of Fitch and Moody's already downgrading Russia by 6 notches to junk status on Wednesday.
Yeah.
They highlighted that the Western sanctions are throwing Russia into a situation where the economy could be weak and they won't be able to service their debt. So it just shows you that all this turmoil does have a big impact on the currency and obviously on their credit borrowing abilities as well.
Sure. Let's conclude this conversation, Matete, with these interesting developments. Our local retailer, the Spar Group, the distribution centers, or should I say its distribution centers in Poland and Switzerland, have removed all products manufactured and sourced from Russia and Belarus. Talk us through those developments.
It's quite interesting. I mean, one person would say that we're at the tip of Africa and this doesn't affect us, but it just shows you how much of a global footprint some of our local retailers have. So, I mean, already the Spar Distribution Group has got centers in Poland and Switzerland. They have removed all those manufacturing products, as you said, that are sourced from Russia and Belarus. What they have highlighted is that these products are few and they're not material in value. And at this point in time, there's no significant impact on the operations of the Spar Switzerland and Poland businesses that they operate there. They've mentioned that they're working with Spar International to assist with the supply of certain essential goods to the likes of Spar Ukraine. But remember something, Tolly, from a corporate perspective and a corporate action perspective, the Spar just came out a few weeks ago to say that they actually need cash to invest in Poland. Now, this is before the unrest and the geopolitical tension between Russia and Ukraine. They said that they need to raise more capital and to fund the rollout of new software and its expansion in Eastern Europe. It did warn the market last year that it might actually withhold or reduce dividends to their shareholders on the back of this potential expansion into Eastern Europe. Now, Spar is struggling to break even in Eastern Europe, which is actually one of Europe, the fastest growing economies that we've seen it. I mean, Spar has noted that they've got great success in the likes of Switzerland and Ireland, and more than 36% of their revenues actually come from overseas, but most of their debt is linked to overseas operations. So it just shows you that, the turmoil there will obviously affect their balance sheet in the next coming few months.
Matete Thulare, thank you very much for that update, sir, on the markets front. He is head of foreign exchange execution at Rand Merchant Bank.